3 smart ways to use your inheritance for retirement. So I'm just going to go through a couple of high points or important things to consider when it comes to utilizing an inheritance or some sort of windfall. We're using an inheritance in this scenario, but it could also apply to a legal settlement, a wrongful death claim, a insurance windfall, or any other number of windfalls. But today we're looking at 3 ways in particular to use your inheritance for retirement. So retirement planning topic in particular, and disclaimer: this is for education, not advice. Feel free to post questions if you have them, and help each other in the chat. So first is just taking the time to assess the lay of the land, see what you have, know what you have, and try to figure out what type of accounts you have, what type of assets in general, whether it's real estate, cash accounts. If there's a trust involved from the deceased, then possibly connecting with their trust lawyer to make sure that everything is accounted for in the estate. And then also just taking the time to gather your thoughts. There's no rush. You don't need to be in any kind of sense of urgency or try to do things faster than what you're comfortable with. It's more so just being able to give yourself the time to grieve and hopefully enough time to get to the place where you can start feeling like you can make some decisions. And if anybody's feeling like they're pressuring you or trying to have you do things quicker than you're ready to do, then you don't need to work with that person, or you can do things on your own time frame. Tax implications: you'll want to try and get an assessment of what taxes are due, if any, in relation to the actual estate or the inheritance. Possibly a CPA or a tax advisor, a tax preparer might need to come into the picture, but not always necessarily. It could be something where it's just like I have here, a traditional IRA that becomes your IRA. Now there are of course tax implications with regard to the IRA that will come into play later as you start to use the funds, but you're not going to get taxed on them just for having the account, just for inheriting the account. It's more when you start to distribute money or take money out of the account or transfer money even to yourself. You want to make sure to do it in a way that abides by the rules, which we'll talk more about here in a minute. And then just any other restrictions that are in place with the trust, you'll want to be aware of those. And that's probably where a trust lawyer will come into play to make sure that you're just abiding by those distribution rules. Next would be just some common inheritance mistakes to avoid. And one I kind of already touched on with regard to taking the time that you need to get your entire situation in order. So that more is related to emotional spending, feeling like you need to start spending stuff right away, or not taking the time to put a plan in place. And then also just, again, on the taxes, being able to have a plan with regard to what you're going to owe come tax time in April, most likely, of the following year. And so we're going to talk today here even about some of the long-term type planning you can have in place to feel like you have a strategy and just a little bit more of a target on where you're going and what to do with the funds. So that involves goals and being able to put in place some kind of objectives or targets or things that you want to have happen, whether it's long-term stuff like retirement, or it could be shorter term if you need to purchase a vehicle, or maybe there's some educational goals, college for yourself or for a child that you need to or want to provide for. It could be real estate purchase of some sort, buying a home. But I think getting those 3 or 4 or more or less goals in place in writing, kind of put some specifics. What's the time frame? If you can guesstimate, do you want to retire in 5 years, 10 years, 20 years? Do you want to have, X amount of dollars per month net of taxes that you can spend for the rest of your life in retirement? If it's a real estate goal, do you have kind of a ballpark range of a price that you want to purchase the real estate at? And is there a payment or an amount that you want to be able to pay per month for the mortgage? And how much of a down payment are you going to want to put down? So those types of questions and ideas are the things that you want to be getting some specifics on. Ideally, you have some kind of a time frame, a dollar amount, and then just kind of jot down a quick reminder of what's important about that goal, just so you're able to kind of center it on what's important to you. This would be, next would be creating a recession-proof fund. Another word for that is like an emergency fund, but this is more so as it relates to the investments. And within your investments, especially if you're approaching retirement, or especially if you're in retirement or within the next year or two, you want to have a portion of funds, if you can, inside your retirement assets, your retirement investments that are more stable, that just aren't subject to the ups and downs of the market. You're of course going to want some that's in growth mode if you can. That way you keep up with inflation long term and just have enough money for life. But having a portion of money set aside, whether it's months worth or years worth of expenses, that is just a backstop that gives you some solace or peace of mind when there is a correction or a bear market, that you can lean on those funds and they're not going to go up or down. They're going to stay stable, maybe even earn a little bit of interest. So that could be like a high yield savings account or a CD or treasuries or a money market fund, but having a specific kind of allocation within your investment portfolio that is meant to be just a buffer, something to be able to absorb the shocks, if you will, in the market, especially in retirement when there might not be working income. There could be working income, whether it's part-time or some kind of a, semi-retirement type job, but it would be good to have just a good idea of what per month do you need to live off of expense-wise, and then how many months worth do you want to have just as available so that way you don't have to pull off or spend down or sell some of your investments. So typically in the 2-year range, give or take a year, when you're in retirement, you want to have that as a reserve in just cash or cash equivalents. And then, being able to plan for longevity. Retirement could be decades especially in a marriage with two healthy people, non-smoking people. 30 years of retirement is not out of the realm of possibility. It's becoming more and more likely, actually. If two people are, let's just say, average age 65, married, the likelihood that one of them is going to live into their 90s is probably pretty high. And health advancements, and we're living longer, and people are just making better decisions for their health, exercise, and nutrition. So just having that in mind in general helps center the goals, because if you know that there's decades worth of expenses to provide for, it helps you determine how much of your funds need to be trying to keep up with inflation, in growth mode, and things like that. Taxes, you want to be aware of taxes, of course, timing distributions. So in a taxable account or a brokerage account, whenever you sell the positions, whether it's ETFs or mutual funds or individual stocks, there is potentially a gain or a loss. Could be a gain or a loss, but you're going to recognize that in the year that you do the sell, and then you'll get a 1099 at the end of the year that'll basically tell you how to input that on your taxes, or you'll give it to your tax person, and that'll affect your taxes. So if there's a bunch of short-term capital gains, then it'll just be taxed at your regular income tax bracket. If it's long-term capital gains where you've held the positions for a year or more, that's a little more tax advantageous. Typically around 15% is what you're going to see for long-term capital gains tax, but it could be 0, it could be 20%. If your income is low enough, it'll be 0, but usually 15% is a good guesstimate or estimate for what you can expect when you sell long-term gains. And you could even do strategies where you kind of tax loss harvest, or you offset gains, where if there's a position has a loss you can sell that at the same time you have the position that has a gain and distribute those funds to live off of, but you don't pay any tax because they offset each other. Roth conversion is another more of a long-term strategy, especially if, let's say you have an inheritance and you're about to retire and the inheritance even helps you retire, because now you have the funds available and you're going to have less, you're going to be a lower income tax bracket. Let's just say in this scenario, if you retire. So in those years where you're in a lower income tax bracket because you don't have earned income the way you used to, those could be a consideration for converting inherited IRA money to Roth monies. Inherited traditional IRA funds, you're going to get taxed when you make the distribution. But if you inherit a Roth IRA, there's no tax when you distribute the funds. So a potential consideration would be to convert when you're in a lower income tax bracket, like if you're taking a sabbatical, if you're retired, if you're taking a break from work, maternity leave of some sort, paternity leave. And then the idea is you convert it at lower tax rates, maybe 12%, 22% tax rates. And then later in life, if you're in a higher tax bracket, maybe because the government raised tax rates, or maybe you have a pension or social security that you're now taking income and it bumped you up into like the 24 or 32% tax bracket, then you would have effectively been able to do a tax arbitrage where you're saving the tax because instead of pulling the funds out when you're in the 32% tax bracket, you converted at 22% in this example. And now when you go to take them out in the Roth, they're not taxed. So that would be a Roth conversion purpose. However, most people don't realize that if the tax brackets stay the same, if you're in the exact same tax scenario when you convert as to when you spend the money, there is no difference. It's going to be it's going to net out to a net zero, gain or loss. Whether you converted at the same tax bracket and then pulled it out at the same tax bracket, it's just going to be the same difference. But Roth does simplify things because if you have all your funds in a Roth and you're retired, then you don't have to think about what the tax rates are going to be in your state if you move states, or who the president is, or what kind of Congress, changes are being made with the tax code. It doesn't affect you as it relates to income tax rates because it's all tax free. So investment options for inheriting money. These are just three broad asset classes. You could be in growth mode, which would be more like stocks that pay a dividend or that the price grows. And you want to be diversified if you can, invested in hundreds, if not thousands of companies. I like low cost index funds, low cost ETFs, where you're investing in a bunch of companies. So you're not, you don't have exposure to any one company going under or dropping in a big way. And it keeps the costs fairly low within the investments if you're doing more like index funds or ETFs, as opposed to like actively traded investments or mutual funds, which tend to have a higher expense ratio, or just the cost of trades and of taxes really from buying and selling if it's in a taxable account can start to eat into your returns. Fixed income assets, that's more like bonds, CDs. These come into play, especially if you have more of a near-term goal that has more of a certainty of when you need the funds. So for example, let's say someone has a child starting college in 5 years. You need X amount of dollars in 5 years to start paying for tuition. Well, that might be a scenario where you start using more like 5-year bonds or lower duration bonds, or you just have a portfolio of a diversified mix of corporate bonds and international and treasuries and things like that. So it's just a little bit more stable. But if you have decades, like we talked about in retirement, to invest, you can still have a good amount of your funds, of course, depending on your risk tolerance, your goals, your situation. We would talk about that, or you would talk about that with your advisor. But you would want to have growth vehicles because there's inflation, costs rise, and maybe you even have an inheritance type of a goal yourself to send money on to the next generation, to your kids. And in that scenario, you would have basically their time frame to invest. So that would be even more, decades, 5 decades, who knows, to invest. So you can have a longer term horizon. So you can be more in fluctuating type investments like equities, because you can ride those out long term. And then of course you want a cash reserve for contingencies like we talked about before. You want a cash reserve like in your personal bank just so you can have funds sooner. That would be like more like 3 months of expenses. But then, like we talked about, you would even want to consider a more of a recession-proof fund that I'm calling it inside your investments, so that way you don't have to spend them down in a recession. So like we just had here in 2025, the recession, not the recession, the tariff reaction essentially to when they were announced in early April. And if you didn't have, a portion of funds in your investments that were stable, you were probably feeling the panic, if you will, of not knowing how far it's going to drop. It dropped about 20% in the market, the SP 500, just use it as a proxy before it started to recover. And in hindsight, now that we're in May, it seems like, oh yeah, it was always going to recover. But in the moment, in April, there was a lot of terror talk and just things of doom and gloom, and a lot of people predicting, the worst. So in those scenarios, you want to be able to just have some, kind of a pressure valve to release some of that angst or stress. If you're reading news headlines and financial media, which you probably shouldn't, do very much anyways in terms of a balanced diet of information, you want to have that be like the sugar, the low consumption media, just so it doesn't affect you as much in retirement from an investment standpoint. Because the worst thing you want to do is sell after it already dropped, and then once it returns like it is today, the market, buy in after, then you get hit twice. You lost on the way down, and then you got lost on the way up. So being able to stick with it long term, that's what an advisor helps you do. But that's the general idea. I'll go back once more and just discuss some of the tax implications, in particular with an inherited IRA, because those come about a lot, and when to take the money and how to take it. In general, let's say you're a child of the deceased and you inherited, your mom or dad's IRA. If they haven't started taking required minimum distributions yet, also called RMDs, if they haven't already started those, which usually they would probably have been like in their 70s, to have started having to take those, depending on which year. But just in general, if they were in their 70s, there's a probability that they were probably already taking their required minimum distributions. Then in that scenario, most likely you'll have to continue taking out an annual distribution amount, required amount, for 10 years. And then in the 10th year, you have to actually take all the funds out. So a few years ago, the government got rid of the stretch IRA for certain individuals, like the kids, the children of someone who's deceased, where you can't stretch it for lifetime anymore. It's got to be taken out within 10 years, which affects your taxes, because every year you distribute money, you take it all out. You every year you distribute money from an inherited IRA, you get taxed. And so you'll want to plan for that, because if you wait all the way to the 10th year, if you were allowed to take all the money out, then you would get a bigger tax bill than if you split it up over 10 years. Or if you didn't know that you were supposed to be taking required minimum distributions throughout those 10 years, then you would get penalized, because there's penalties. They've recently reduced the penalties. It used to be a 50% penalty, 50% tax on if you missed a required minimum distribution. Now I think it's more like 25% tax, which is still high and crazy, but that's just something to be aware of. If a parent in this scenario, let's say you're the child of a deceased and you got an inheritance, an inherited IRA, if your parent hadn't started taking required minimum distributions yet, they were young enough, then you don't actually have to take an annual distribution. You just have to take them out. You just have to take all the funds out within 10 years. And by the 10th year of, your parent being deceased in that scenario. So just some more heads up information specific to inherited IRAs, because those tend to be pretty common. Thinking about a professional team that could help, a CFP professional, which is what I am, so I'm biased towards that. Someone who's a fiduciary fee only, which is what I am, and just helps remove some of the conflict of interest. A tax advisor, we advise on taxes here with our clients. like we're talking about even here with that scenario with the inherited IRA. But a tax preparer might be necessary, a CPA. We don't prepare the tax return or sign the tax document, but we do the planning and the advice. And then even an estate attorney might be helpful, whether it's talking with the previous estate attorney for the trust, if there is a trust involved in an inheritance, or getting your own trust set up now that you may have enough assets to necessitate that. So inheritance is an opportunity. You want to make sure to utilize it if you can. And aquilawealth.com is where you can find us, my company. We can do a complimentary phone call and just help discuss what sort of things you're trying to accomplish with an inheritance. And even if we don't work together, I can help get you pointed in the right direction. Thanks for tuning in. As always, I'm sure there'll be more live streams to come. And again, you're welcome to put comments or leave any kind of questions, and I'll address those in the chat or even in a future live stream.